Hi, IBD. I'm Meredith Heyman. This is IBD Explains. Thanks so much for joining me. Everything from food to cars to rent has gone up in price over the last few years. The monthly CPI report, or Consumer Price Index, measures that change in consumer goods and services. Joining me to break down what investors need to know about the data is IBD Economics reporter Jed Graham. Hey, Jed, thanks so much for joining me.
Thanks for having me.
Absolutely. So, what do investors need to know on a monthly basis about these two reports, the CPI and the PPI report?
For one thing, the bond market's probably going to react when you get a report that shows hotter inflation than expected, especially core inflation that doesn't include food and energy, or yields could come down if prices are tamer. Um, the big picture is that we're trying to get back to 2% inflation, and the Fed will have a more supportive attitude for investors if if they're confident that 2% inflation is in sight. Rate cuts would be in the pipeline. Maybe the most important thing out there is the inflation backdrop, because it determines how fast you can grow the economy. If the economy is growing fast, you have strong earnings. But if inflation is a worry at the same time, then you have the Fed fighting the positive vibes in the economy, basically.
Absolutely. Now, the CPI report covers a variety of different pricing groups, but which of them is the most important for investors?
Well, generally, you'd say services inflation. Um, Usually goods inflation isn't much of a problem. It hasn't been lately. Goods prices have been falling a little bit, or core goods, which doesn't include the food and energy. Services is seen as tied to trends in wages. When wages are growing fast, then services inflation could heat up. So that's usually the one to watch. But you can have big moves in things like used cars, airline fares, and new vehicles that can change the picture quite a bit. So, it depends on a month-to-month basis, but yeah, services is generally what's most important.
Absolutely. And how tied are these reports to the PCE index?
So the core PCE price index is the most important inflation number out there that really determines whether we're on our path to 2% inflation. About 70% of the PCE data comes from the CPI, and about 30% comes from the PPI. A big part of the information that comes from the PPI is healthcare services prices. So that's what makes that report particularly important.
How do these reports move interest rates and the bond market?
If they come in hotter than analysts have expected, then the consensus estimates, then yields will go up. The opposite if they come in lower. But basically, what we're looking for is how everything compares to trend inflation. If you get like a 0.4% increase in, say, the core CPI, well, that's above trend. Generally, you want to see 0.2% increases. That's pretty much on target for the CPI. The PPI, we're not as much worried about. The headline numbers, they matter, but a lot of the stuff below the surface, like healthcare prices, because that is actually the biggest piece of the core PCE price index. If you're getting tame healthcare prices, that says really good things about where inflation's heading.
And Jed, finally, how do the CPI and PPI reports affect the stock market?
Well, we've seen in recent years that inflation is a huge issue for investors. If inflation's too hot, interest rates have to go up or stay high, and that limits how fast the economy can grow. that limits earnings growth for corporations. Tame inflation is something investors love to see. Investors want the Fed on their side. If the economy weakens, if inflation's too high, even if you get slow growth, the Fed is not going to be cutting rates. If inflation is where it needs to be and you get slow growth, well, then the Fed can provide support to the economy and make sure meet its mandate of making sure that we have full employment.
All right, Jed, we'll be watching. Thanks so much for joining me. This is IBD Explains. I'm Meredith Heyman. Stay right here on IBD for more. We'll see you next time.